Good morning from our global headquarters in New York. I'm Manny Screeney. You're welcome to Bloomberg Brief. Let's set that agenda. Trade war fallout. Beijing weighs formalizing a probe into Apple. The U.S. Postal Service halts inbound parcels from China. President Trump proposes a U.S. takeover of Gaza, sparking a rebuke from Palestinians and Arab officials. And a bad day for tech. Alphabet and AMD tumbled on disappointing earnings. Qualcomm is up next. Good morning. We shift from a managed de-escalation on tariffs and trade yesterday to the reality of tech in search and chips, and also the obfuscation by the United States Postal Service in terms of packages from China. This is about a risk to the tech composite. That's really what the market is worried about. Alphabet took $200 billion off its market cap last night. We'll talk more about that in detail. Bucking that trend is Meta, up 12 sessions in a row. Roll it over, have a look at the bond market. The risk is this, that you have a macro slowdown as a result of tariffs, job openings at a 3-month low, and an abundance of caution from the Fed. Yields down 3 basis points this morning as we see this equity market, really the shine come off it from tech, so money flows to bonds. Goolsbee, Bowman and Jefferson up today. Will they add to the abundance of caution that has been proposed by Mary Daly and Austin Goolsbee yesterday? So those bond markets are picking up the slack. They are the defense to the equity storm this morning. There are individual names that are on the move. AMD is top of that list, dropping as the chipmaker reported data center revenue that was weaker than expected, despite growing by double digits. It was all about the guidance, down 8.5%. JD.com also falling as the U.S. Postal Service temporarily suspending inbound international packages from China and Hong Kong. And Apple down. Bloomberg reporting that China's antitrust watchdog is laying the groundwork to formalize a probe into Apple's practices. And this is around the fees at the App Store. In just a few moments, Monica Defend from Amundi Investment Institute joins me to discuss first reaction to those breaking headlines this morning from China. And Marvin Lowe from State Street. What are you worried about in the bond markets? Well, the trade war has begun to take effect. The United States Postal Service temporarily halting those inbound packages from China and Hong Kong. Shares for Chinese retailers, as we said, Alibaba, JD.com, on the back foot this morning pre-market. Meanwhile, you've got China's antitrust watchdog formalizing the groundwork for a potential probe into Apple's policies on their fees that they charge the app developers. It's been running for a while. Apple is down pre-market. China's Ministry of Foreign Affairs called for diplomacy.
What we need now is not unilateral additional tariffs, but dialogue and consultation based on equality and mutual respect.
Joining me now to run through the escalation, Brendan Murray. Brendan, I look at the United States Postal Service and I ask myself, intended or unintended consequences. But I look at the language from China, but then this probe, the escalation on these antitrust probes is perhaps the more malevolent kicker here.
Yeah, exactly. So these are basically just the latest jabs that we're seeing the U.S. and China throw at each other in a brewing trade war. The U.S. Postal Service move on the U.S. part is really aimed at closing a loophole, a big loophole. There are something like 1 million or 2 million small packages arriving into the U.S. through e-commerce channels. A big one of those is from China, and so the thinking from the Trump administration is that there could be fentanyl being smuggled into these smaller packages, and just basically tariff avoidance in general. So they're closing down those channels. The Apple move on China's part is definitely an interesting move in that China is saying to the U.S., how are we going to hit back at you? We're going to hit you where it hurts, and that's your big tech companies that lead the world in a lot of different ways. So interesting steps, just gradual steps at this stage. There's no giant escalation of anything, but just a kind of tit for tat. You hit us, we're going to hit you back, going back and forth in now week 3 of the Trump administration.
Yeah, it started yesterday with tit for tat. It sort of shifted gears in the past couple of hours. Brendan, thank you very much. Brendan Murray there. Joining me now is Monica Defend, head of Amundi Investment Institute. Good to have you with us, Monica. Look, we're in the foothills of a trade war. We're 13 days on from DeepSeek. And these antitrust investigations into Intel Alphabet and NVIDIA. How do you assess these moves relative to what was seen yesterday as a calibrated response from the Chinese?
Well, I really think that what is clear is that both the US and China are playing this chess game that is not something that started yesterday or last week. It's really something more strategic. And what China is doing has been progressively reducing its dependence import-wise from the US. In 5 years, they reduced 8% the quantity of imports from the US, while the kind of bargaining that we are seeing is really leaving them the room for further bargaining. So it's not really an attack, an hard one, what we are seeing, but they are leaving the room for further discussion. And what China is doing is really targeting on those goods, energy, where they might have some alternatives. And let's do not forget that China has also the room on the fiscal side. So I'm not saying that this tariffs war won't be a drag on growth. In general, this will be a drag for who is imposing and who is receiving the tariffs. But they might play it out, and we will wait for March to see how the fiscal response will be sized out of China.
Well, China can always rely on Saudi Arabia, as it were, to turn on that export tap. Monica,
Exactly.
when it comes to risk, you're becoming more discerning on the US. Is that targeted to equities or just a general step back? And is it directly as a result of tariff escalation?
Well, I think that the asset classes that are really responding to tariffs are notably FX and equities. On the fixed income market is still under the umbrella of the Fed, of the central banks, still in a restrictive territory, but on the way to lower rates, although this will come later in the year. While when it goes to the US equity market, still it's overvalued, concentrated, so it is really a matter of being selective, quality, high dividend stocks where you might, but stay out of technology, for example. While on the FX, probably we will still see king US dollar, which is not unstoppable, but will remain strong as being one of the major diversifier in an asset allocation perspective. So king dollar, queen, volatility for the time being.
Often we look for the unintended consequences. People are floating the idea that the Bank of Canada could go for an intermeeting cut now. People are floating the idea that China will be provoked into a much more significant and serious stimulus response. These unintended consequences can have a pro-risk narrative for alternative markets to the United States, so long as tariff and trade war doesn't run away with itself.
Well, it really depends how these tariffs will be displayed in terms of target countries or sectors, in terms of sequencing, when, smooth, all at once, and in terms of size. For this, we are going back really on the macro fundamentals, seeing who is exposed, who is less exposed, not only at country level, but at sector level, just to seek for alternatives to the US market. And notably in Europe, you might find some nice alternatives. Look at small cap, look at the financials, for example.
Well, the EU, we have a line this morning there preparing in terms of how they actually go about defending themselves. It's interesting because European equities have actually outperformed US equities along with European investment grade relative to the rest of the world. Is that just a short-term blip, or is that something about a tail risk that can improve for Europe?
Well, Europe is starting from a much lower level and undervalued equity market. So if I flag the relation between China and US a chess game, probably in Europe it's more a volleyball match. And it is really important that this does not turn into a beach volley. So the problem that I see is that the Trump administration might push into cracks within the euro. We need really a cohesive answer to the posture of the policy administration shift in the US.
Is Europe really prepared for what might be coming towards it from the United States?
Well, we are very good when a crisis comes into reaction. So if you want to see the glass half full, this might push further into some of the structural reforms of the spending that are desperately needed. We are just discussing the investment in defense, which is not a trivial discussion, but probably I would see this as an accelerator towards better moments for Europe.
Well, the line from Europe this morning is preparing for a proportionate response. It just depends what President Trump levies on Europe in the first instance. Monica, thank you very much. Recalibrating risk. Monica Defender at Amundi Investment Institute. Other stories trending on your Bloomberg terminal. This is what I've got for you this morning. The Nikkei reports that Nissan is pulling out of its deal with Honda after the two companies failed to reach a consensus. That's after 7 weeks of talks, and friction emerged over Honda's proposal for a complete acquisition. Nissan's future is unclear as it faces an outdated product lineup and a shaky leadership. Novo Nordisk expects sales to surge again this year as the drug maker builds supply for the blockbuster diabetes medicine Ozempic and obesity treatment Wegovy. Now, shares climbed after it reported the forecast and better than expected results. The company signaled it will continue to struggle to meet demand this year. Santander said it intends to buy back $10.4 billion of shares over the coming years as it posted another record profit. It partly reflects an ongoing effort to move low-yielding assets off its balance sheet and deploy the capital for new business instead. Shares hit the highest level since 2018 on the announcement. It is all about tech stumbling, Alphabet to be specific. A disappointing outlook for the cloud. What does it mean for the business? We'll tell you that in just a moment on Bloomberg. Bloomberg Brief, I'm Scrutiny here in New York. Well, the tech earnings are rolling in and they are dragging the markets lower today. Alphabet sliding pre-market after reporting revenue miss in the fourth quarter. Joining us now, it is Matt Bloxham from Bloomberg Intelligence to run through the numbers. I mean, Matt, when you look at this cloud business, up 30%, less than the market had thought, but they're telling us, look, we are constrained. So this is part of the challenge for them. We've got cloud, but we're constrained by what we can do.
Yeah, it is, and the Google Cloud business, about $12 billion of their revenue. The miss was incredibly small, about 1.5% on that business, and it was pretty much offset by better than expected advertising sales. But as you say, there is a lot of demand out there for AI products from corporates, and there is this near-term capacity issue. They can't bring enough technology on stream quick enough, and we saw similar comments from Microsoft too. But I think combined with that kind of slightly slower growth, constrained opportunity, and this big $75 billion of capex they're planning, which was a surprise. People were looking for about $60 billion of capex from them this year, so that was a big surprise too. So they've still got these big questions about how quickly can they monetize these huge investments, if at all, or is it just really a defensive measure they have to do that won't really kind of expand the overall size of the business mid to long term?
But then this comes down to that $75 billion, Matt. This sort of chimes very much with, Microsoft last week, along with the narrative from Meta. It's about spending. They all have an absolute belief in continuing with this capex, despite the DeepSeek. What was it Sundar Pichai said? It's a tremendous team, and you can drive a lot of efficiency. So there's still a rooted belief in size and scale deployment of capex.
Yeah, there is, and I think one thing that's important to remember is that data center spend is quite modular. So a lot of that money will be going into the kind of long-term data center infrastructure, but then all of the kit that goes inside it, they can flex that quite easily. So we'll see how the year develops in terms of the efficiency of models, whether you need to spend so much on NVIDIA Blackwell chips, or if you can kind of adjust your capex spending there. And so if they can spend less, I think they'll be able to flex those numbers, certainly maybe into the second half of this year and into next. So it's not all out of their control in terms of what they need to do to kind of keep up in this AI race.
Then this brings us to AMD. AMD down, their cloud business did well, but again, just not as good as the market had anticipated, because they're talking about the back end as being the ramp. But this goes to a much bigger question, Matt, doesn't it? Which is, as we move from chips to software in 2025 and beyond, and that's the risk, really, for the chip sector.
Yeah, it is, and I guess AMD's got this extra challenge that it's really not up to par versus NVIDIA, and that's what people are hoping. Yeah, the scale difference between NVIDIA and AMD on the AI chips is enormous. The NVIDIA business is about a $100 billion business, whereas for AMD it's currently $5 billion. So, yeah, although they're kind of doing relatively well in data centers, they need to be delivering much stronger growth than they're delivering. I think they said they're going to grow 69–70%. Market needs to see them grow much stronger than that to be convinced that they're actually closing the capability gap on NVIDIA, and that companies are choosing AMD over NVIDIA, and I just don't think we're there yet.
Yeah, well, it's a pretty high bar, isn't it, in terms of delivery on these earnings calls. Matt, thank you very much. Bloomberg Intelligence, Matt Bloxham on the tech trail. Coming up, President Trump's proposal on the Gaza Strip. The US should take control. More on the story and context next on Bloomberg.
The U.S. will take over the Gaza Strip, and we will do a job with it, too. We'll own it and be responsible for dismantling all of the dangerous unexploded bombs and other weapons on the site.
That's the latest proposal from President Trump after his meeting with the Prime Minister Benjamin Netanyahu. Here's the Israeli leader's response.
He has a different idea, and I think it's worth paying attention to this. We're talking about it. He's exploring it with his people, with his staff. I think it's something that could change history, and it's worthwhile really pursuing this avenue.
Joining me now is Ros Matheson on the story. Ros, a very interesting press conference. If we look at the framing of this, Trump has moved his rhetoric from where he was on the campaign trail about not wanting to be involved overseas. Here we are. He's talking about doing whatever is necessary and talking about the long-term ownership of Gaza.
Well, that's right. I mean, on the one hand, you have the US president very clearly wanting to have no US military involvement further in a place like Syria. But on the other, this proposal that he floated overnight where he was talking about control of Gaza, that seems to be mostly the idea that Israel would have the ability to control Gaza, but the US would have to back it up militarily. So you're talking about the possibility of quite a big US military intervention in the region. And that does run very counter to what we thought of as Trump when he looks around the world as someone who's quite isolationist, who was really pulling the US back out of conflicts in the world, who didn't want the US to play a role of what he would call global policemen, who wanted countries to take care of their own defense in Europe and elsewhere, is that this would require, no doubt, some kind of heavy US military involvement in Gaza. And so it's unclear if that's exactly how he would see it, but that's the reality when you're looking at the state of Gaza now and the fragility and the complexities of the region. So that's quite a strong shift. And obviously we're many steps from that happening, but it is causing, as you can see, quite a reaction in the region today, just the fact that this is now even in the ether.
Well, let's just talk about that reaction, because we have from the Ministry of Foreign Affairs from Saudi Arabia. And again, the real jewel for the Trump administration was the Abraham Accords during Trump 1. And their objective is that rapprochement between Saudi and Israel. And this is what the Saudis have had to say overnight in terms of their response. It is about a two-state solution. The Foreign Ministry affirms Saudi Arabia's position on the establishment of a Palestinian state is firm and unwavering. His Royal Highness Prince Mohammed bin Salman bin Abdulaziz Al Saud, the Crown Prince, and the Prime Minister clearly and unequivocally reaffirmed this stance. This is placing a very clear wedge on what was supposed to be sort of the pinnacle relationship for Trump in the starting days of this administration.
Well, it certainly could make it very awkward, particularly, as you say, for Saudi Arabia. The idea that Trump very much wants, again, that rapprochement between Israel and Saudi Arabia, normalization, economic ties, trade, business flowing. And Saudi Arabia has been interested in that, but this makes it very difficult politically and in the region for Crown Prince Salman to do that, because he's been very clear too that his foundational point is that two-state idea, the idea of a Palestinian state. And if you have a situation where Gaza is essentially being controlled by Israeli troops, the idea of making people leave Gaza and live in other countries in the region, that's going to make it very complicated for that to occur. And you can see not just the reaction from Saudi Arabia, but also Turkey, Egypt and others today saying again, like fundamentally, our starting point is a two-state solution, and also not, making people relocate out of Gaza and certainly not taking them into Egypt and Jordan. So a lot of the chessboard could move here in ways that we may not yet understand. But obviously that foundational point of the Saudi-Israel relationship in this is going to be very interesting, because it does make it much, much more complicated for Saudi as a result.
OK, and of course, we had Benjamin Netanyahu, just looking at the Washington Post, lavishing praise is the phrase that they use. You say other things that other people refuse to say. So it's interesting to see the gap between the two of them perhaps changing. Ros, thank you very much. Ros Matheson on the very latest from Washington. From our global headquarters in New York, you're welcome to Bloomberg Brief. I'm Menace Cranny. Let's set that agenda. Trade war fallout. Beijing weighs formalizing a probe into Apple. The U.S. Postal Service halts inbound parcels from China. President Trump proposes a U.S. takeover of Gaza, sparking a rebuke from the Palestinians and Arab officials. And a bad day for tech. Alphabet and AMD tumble after disappointing earnings. Qualcomm is up next, and it is that shift in the narrative. Tech has bounced from its lows. We're now down 1%, but it is very much about the risks around Alphabet, the risks around AMD. Alphabet wiping $200 billion off their market cap last night. And then you wake into this recalibration on the tariff escalation, the trade war risk as the Chinese now go for a formalization of the probe. Roll it over to the bond market, because the debate is this: are we in for stagflation? That is the only question you really need to ask yourself. But as equities take a real beating this morning, money goes into bonds, 447, comfortably below that 450 level, which is incredibly important in the psychology of the bond market. There's a caution of abundance from Mary Daly and Austin Goolsbee yesterday. Today you get Goolsbee, Bowman and Jefferson. And Morgan Stanley have moved to one cut and done, and they shredded their March cut. To be fair, they were an outlier on that. Right now, bonds are bid, yields are dropping. State Street's Marvin Lowe weighs in on the impact of President Trump's tariffs, writing this: one thing is clear, the tariff genie is out of the bottle, and it likes its freedom. So the market premium associated with tariffs will need to remain in the market. Marvin, I'm pleased to say, joins me around the desk this morning. So the genie has been released. There's no doubt about it. Day 13.
Yes.
I think we all feel as if a truck has run over the top of us. But where is risk most underpriced?
You know what? I still think that the market is holding on to an off-ramp when it comes to these tariffs. And ultimately, valuations around the equity space are still quite rich. So, I think that there is a case that we do get tariffs as a means to an end. But really, we're not pricing in the possibility that universal tariffs are much wider than what we saw back in 2018.
Adam Posen was with us yesterday, and he said the risk is that they legislate the tariffs and they become permanent and enduring because they pay for the tax deal that he wants. That's the risk, and then that has a knock-on for growth.
For sure, absolutely, yeah. I believe that the market is ignoring the growth aspect of tariffs, and the Fed did a study on this back in 2018 where they kind of looked at what the impact would be from universal tariffs, and they came to the conclusion, sure, inflation could be transitory, but there is a potential knock-on growth that not only slows it, but potentially drives some recessionary impulses through the economy.
So then let's go to the elephant in the room. I can't work it out. Flatteners on Monday, steepeners on Tuesday. I don't think this bond market really understands. For you, are you a stagflationist? In other words, you see this curve steepening as a result of inflation and lower growth, or do you take the alternative road?
So I am in the bear steepening camp. I do think stagflation is a concern, which ultimately keeps the Fed out of the picture because it's really addressing kind of inflation expectations. In theory, that's a curve flattener kind of environment. But I do think that we're adding so much concern into the market that the long end becomes somewhat unattractive. So that bear steepening is still a trade that keeps me hesitant to really embrace duration.
Where does that extension at the long end take me to? Because the consequence of that is an exuberant correction in equity.
Yeah, for sure. So for a while, I've been saying 5.25 is what you should be thinking about from a 10-year perspective. It's not going to be a straight path. There's a lot of reasons to drive kind of this recessionary concern, which created the flattener earlier in the week.
Yeah.
There was a view that, you know what, maybe we weren't pricing recession enough. That certainly is a catalyst for a flattener. But ultimately, the economy looks fine to me.
I mean, this is a healthy economy with a strong, spending. Savings are rolling over a little bit. The jolts came in yesterday, though. Yeah. Is there anything in the data that suggests that we are going toward a deceleration a little bit more than you thought?
No, not really. Not really. There's a lot of data points. There are positives and negatives. I think one of the risks is that from a survey perspective, now that the elections are done, generally speaking, small business gets more enthusiastic when we have a GOP type of environment in Washington. Some of that survey data is coming in strong. Can it last? Will it actually extend into the second half of the year, or is it a false positive type of view?
Okay, so we squared away the equity side, the stagflation side, steepeners, perhaps pare back your risk. What about an inter-meeting Bank of Canada cut? The unintended consequences of this trade war will provoke more activist central banks.
So that really speaks to the disparity that we're starting to see across economies. So that's why FX ultimately is, in a way, the purest way of playing some of this trade concern that you have. And while certainly it's this administration that's driving a lot of the conversation, driving a lot of the turmoil, if you will, a lot of other economies will likely suffer more than the U.S., kind of just based on the way the U.S. economy is structured. So yes, Canada, Mexico are for a reason some of the top names that the administration is talking about, not only because they're large trading partners, but they're very much tied to the U.S. economy. And if you're going to cut deals, those economies need to cut deals. And if they don't cut deals, then you really do have some economic impact that will look much worse than what we're dealing with here.
But you don't think we get to that extreme, given the theater that we've seen in the past couple of days?
Trying to get into the mind of Trump feels like a losing game. I think that, like I said, the tariff genie is out of the bottle. It's going to be part of the story for the next several years.
Okay, then we played defense. Yesterday, Mads Peterson was with us, and he said he wants to be long 2s, 3s, 4s, and 5s. He didn't want gold. He didn't want the dollar. What you've just said to me is dollar is pure defense to high beta in Asia and indeed to high beta in commodity.
Yeah, I do think the dollar smile kind of theory is out there. I think the dollar does give you a lot of protection. So, I could be concerned with dollar homogeneity, but, while we were talking on the break, that's something that's, quite in the future. So right now, when we're looking for those relative pockets, the dollar still makes a lot of sense to me.
The biggest risk, in terms of the off-ramp, the market is hopeful for an off-ramp. What is it that qualifies clearly to you de-escalation versus escalation?
Like USMCA. It's up for rediscussion this year. If in fact we get a new deal more aggressively and earlier than we expect, I think that that's a fairly positive sign. And then I think we think about some of the more sophisticated games that they might be playing. Is there a real focus to create an alliance that focuses on China? So I think all of that is in play out there.
A much bigger grand bargain, perhaps, to be had.
Yeah.
Marvin, thank you very much. Marvin Lowe there from State Street. It's official. He's a stagflationist. Coming up on the show, China looking to formalize the probe into Apple as the trade battle with the US escalates. More on the story. That's next on Bloomberg. Bloomberg Brief. I'm Marvin here in New York. So the tit for tat between the US and China in the trade battle, it is escalating. Packages from China and Hong Kong have been temporarily suspended by USPS, hitting shares for the Chinese e-commerce giants, the likes of Alibaba, Temu's parent company PDD. And a potential retaliation, China's antitrust watchdog is weighing a probe on how Apple runs its App Store and the fees that it charges to developers, hurting Apple stock this morning. Mike Shepard is tracking the stories for us from Washington. Mike, this is a formalization of a probe. This is an irksome thing that's been ongoing in China. It's more a question of how China is calibrating these antitrust probes, and perhaps that's the more malevolent part of the escalation of trade war at this juncture.
Yeah, you're right. This does predate Trump's tariffs campaign against China, which was unveiled formally on Monday and took effect Tuesday, first thing Tuesday morning here in Washington. But it is turning into this bargaining chip or this other element of complication and uncertainty for the U.S. and U.S. tech companies, especially Apple, as this really kicks off. We still haven't seen that conversation between President Donald Trump and his counterpart in China, Xi Jinping, to talk more about trade the way we have with his Mexican counterparts, Claudia Sheinbaum and Justin Trudeau. So we don't know what kind of runway this will actually have. The complaints against Apple really center on its App Store practices and policy, and they echo concerns that were reflected in the European Union. And Apple has since made some changes to the practices of the App Store in that market, and this is to reflect the EU's Digital Markets Act. In China, some of the same complaints: you're charging developers too much, you're not allowing third-party payments. Complaints have been raised by the likes of Tencent and ByteDance, but into this, you're also throwing in the trade war as a mix. And for Apple, this is significant. China is their second largest market outside the U.S., and it's also a significant production hub. And in the last quarter, we did see sales in China fall by 11%, and they're facing some stiff local competition these days. So this is yet another issue now in their right in their faces.
It's interesting. We woke in this morning and you have this red headline on the United States Postal Service, stopping anything that's under $800 coming into the country. I mean, you've got to ask whether this is the intended consequence, i.e. disruption, or an unintended consequence by one company.
Well, this is actually an intended consequence because we are thinking of Amazon. We think of who would benefit potentially from seeing Shein and Temu, two discount retailers based in China, whose online sales and appeal have really grown in the U.S. in the past couple of years. The two companies have been responsible for a significant jump in what is known as de minimis package shipments into the U.S. And de minimis refers to anything under $800. A package containing goods less than $800 is not subject to customs and border protection scrutiny and tariffs. It just sort of slips under the wire. In theory, that would be okay. You're thinking of like a mom and pop store or maybe a family sending goods to a loved one here in the U.S., but it is actually retailers sending lots and lots of small packages. And retailers here have complained that, hey, wait a minute, this isn't fair. This de minimis exemption is hurting us. And so it's been something discussed here in Washington, but it is taking on a new flavor here now with the 10% tariffs that Donald Trump has imposed additionally on Chinese goods. And now, keep in mind, this is only the U.S. Postal Service. There are a lot of other shippers from China to the U.S., FedEx, there are a bunch of others. So we will have to see how this plays out along the shipping chain as well. But it is an important signal to those companies that, hey, wait a minute, you are also in the crosshairs too.
Okay. Mike, thank you very much. That's Mike Shepard on the very latest there from the potential escalation in the tit-for-tat trade war. Well, the latest tech earnings, they're in, and U.S. stock futures, as you can see, under pressure this morning. Two big names on the move, Alphabet and AMD, both reporting results that fell short of the street's expectations. Let's break down the numbers and the sentiment, probably more importantly. Matt Bloxham is from Bloomberg Intelligence. Matt, when I look at a $200 billion wipeout for Alphabet, just how bad or how many questions does the miss on the cloud raise for me? Do you buy into the capacity constraint? And if they have a capacity constraint, who's winning? Who's taking that capacity?
Yeah, I mean, in context, they missed by about $200 million, so it's tiny, 1 to 2%. And so I think it does really kind of play into more of these kind of concerns on multiple levels about whether Google can really develop a big business in cloud, whether it's kind of gaining share from bigger rivals like Amazon and Microsoft. And I say capacity constraints, not just a Google issue, but we've seen those across the industry too. But they're spending a huge amount of money this year on CapEx, $75 billion, mainly on data centers. And as you said, who are the big winners from that? It's quite a big range of people. I think clearly NVIDIA is one of the big winners. But then you get a whole bunch of industrials companies and infrastructure suppliers that actually have to kind of build the physical plants. So quite a wide range of winners on the back of that $75 billion spend.
I mean, this plays then into what Sundar Pichai was talking about. He talks about DeepSeek as being an amazing opportunity, tremendous opportunity, is the verbatim. So they're all kind of sticking to their guns in terms of this mammoth capex that they're prepared to lay out and stand by.
Yeah, they are, but I think that can evolve. We've seen the capex numbers go very quickly to the upside. 50% increase for both Google and Meta in the last couple of weeks announced. They can quickly come down again too. I think we talked about this earlier. Capex is quite modular. You have to build the infrastructure, but all the chips and servers and everything that goes inside, if the demand doesn't come through, then you can put a brake on it. So I think that they're clearly investing for a very optimistic view of where the AI market is going. If it's slower to materialize, I think you could see them kind of pull back on some of that spend.
Well, look, we've had AMD under serious pressure. We've got Qualcomm coming up next, and there is this narrative that we shift from, chips, max chips, to sort of that evolution into software. This is the year for that. How should I prepare for Qualcomm, given the AMD background?
Yeah, I mean, I think for Qualcomm, the focus is going to be on the smartphone market, which has been a little bit mixed recently, and obviously Apple with some weakness, particularly in China, but also their extension into new product markets, like particularly the automotive market, and obviously with the whole Trump tariff situation going on, and the autos getting hit quite hard by that, and the pullback on demand for EVs. It'll be interesting to see how buoyant Qualcomm are about the growth opportunity in that particular vertical.
Of course, they are inextricably linked to Apple and the iPhone. Matt, thank you very much. Matt Bloxham, the Bloomberg Intelligence on the tech trek. Other earnings, Disney is set to report their fiscal first quarter numbers before the bell. Let's bring in Charlie Wells. Charlie, the street positioning for Disney, how do they prepare for today's report? Because this is going to be about theme parks, but at the same time, it's going to be about media.
That's exactly right, Manus. I mean, Disney's share price from a year ago is up about 17%. So pretty positive expectations going in today. And a lot of those positive expectations are coming from the film and television streaming businesses. Those are expected to help lead sales and profit growth in the quarter. And when you think about what Disney's been doing over the past few months, they've really been hitting it out of the park on content. And that is so important for this business. When you think about films like Moana 2, that's actually grossed $1 billion since it was released in theaters in only November. I'm also thinking about films like Mufasa, which have really been adding to that content slate. So really helping Disney there. And they get the synergies from that, of course, right? Not only for these films, not only for streaming, but also to parks. There's some uncertainty around parks. They took a hit in the last quarter because of those hurricanes to the tune of about $130 million. And there are also some concerns about linear television. But really, it's those streaming, it's those franchises, it's that entertainment that really should help buoy Disney this quarter.
If you've got to be fully bullish on Disney, what are the parts of this report that you've got to focus on most? Obviously, you've got the parks, you've got the media, as you say. But if you're to continue on this trajectory of belief in Disney, what is it that could maybe get in their way?
Yeah, Manus, you really got to think about the momentum here, right? So, it's one thing to have a hit, but you've got to keep producing them. I think that's the real difficulty here. I think the other question here really is about parks. I think it's easy to forget how much revenue these parks bring in. And of course, the story since the pandemic, really the story over the past 4 or so years, has been one of growth at those parks. They were shut down for a long period of time. And so it's been not easy, but it's been a story of kind of growth from kind of kind of a low base there. So really, I think to be a bull on this stock, you've got to think that this business can keep that momentum going. They can create that kind of positive synergy I was talking about. You get the hit film, that brings in the merchandise, that brings people to the parks, and it keeps on going.
Okay, it keeps on running. Charlie, thank you very much. Counting down to the Disney numbers. We'll break those as they come. Charlie Wells in London. Take a snapshot of gold. Another record high. I mean, it has been making record highs over the past couple of days. The trade war angst rises. Marvin Lowe from State Street has just been with us. He is talking about stagflation as being his base case. Where do you go for havens? Is it bonds? Is it gold? Is it the dollar? Right now, another record high for gold. It's Bloomberg Brief. I'm Manus Crenny here in New York. Let's look ahead for the rest of the day. More earnings to come. Disney, as we've just discussed, along with Uber. They are before the bell opens. We also get a little bit of data for you. ADP employment data at 8:15 Eastern, followed by the PMI at 9:45 and 10 a.m. On the slate, you've got Ford, Qualcomm earnings, all after the market closes, and our exclusive interview with the Richmond Fed President, Tom Barkin. That is at 7:30 a.m. An abundance of caution coming through from the Fed speak yesterday. What will Barkin have to say? Micro movers for you. This is what we got. Broadcom rallying after customers' Alphabet forecasts higher capex spending. Chipotle extending its post-earnings decline. Sales miss signals a little bit of a slowing growth. Get out there, get your dinner in. And Match sinks on growth concerns and a lower guidance, down 8.91%. Ground zero for risk this morning is about technology. It is about the miss on the cloud from Alphabet, coming in slightly below estimates, and that really has irked the market. ADM, likewise, again, on the guidance of what they can do for chips at the back. The reason why I put Meta in there is because actually it's just broken a run of 12 sessions in a row on the upside. That's the longest winning streak ever. So you look at Meta relative to NVIDIA and you begin to understand some of the differentiation in the Mag 7. Let me just show you what's going on with stocks. It is about what's happening with technology. $200 billion being wiped off. Alphabet is knocking the NASDAQ, those cloud sales falling short. So what the market is grappling with here is the juxtaposition between what was yesterday a calibrated response on the trade wars to something which is perhaps a little bit different as these antitrust formally investigate by China into some of the big tech players. A quick snapshot of the bond market. This is where really, you've got to sort of say they're picking up the slack. Yields are down at 447. Marvin Lowe was with us just a short time ago from State Street. He's making it very clear. He believes that you will have bond steepeners and that longer end in duration could get to 5.25%, 5.5%. That is a heck of a call from Marvin Lowe. That's it from the Bloomberg Brief team. Surveillance is up ahead.